everybody, it's Tom Sheridan and Ben Kumar from 7IM, here to talk about 7IM portfolio positioning as we go into 2018, just on the heels of the asset allocation meeting to decide those things. What we'd like to talk about briefly is what happened in 2017, then we'd like to move on to what the road ahead looks like, a little word on Brexit, and culminating in the portfolio positions in 2018 going forward. Now, first of all, Ben, looking back at 2017, what did we see? What did we do? How did it turn out?
We saw from the economic side exactly what we expected, which was synchronized global growth. Everything, every country growing at rates they haven't seen for nearly a decade. And that translated into corporate earnings, the chart on screen now. In most of the major regions, companies are making profits at rates they haven't seen for a long, long time.
So we had a lovely macroeconomic environment. What happened to markets?
Markets rallied. Markets rally when the macroeconomics is good and when companies are making profits.
And how were we positioned, and then how did that turn out?
Well, we were positioned somewhat cautiously because while the macroeconomics looked good, we were worried about a few tail risks out there. So we were prepared to protect against the tail risks and sacrifice a little bit of the upside.
So basically, 2017, the surprise for 7IM was that we didn't have any surprises.
Absolutely right. We did not see sterling move out of its range too drastically. We did not see an equity market fall on the basis of valuation. We did not see an interest rate rise in the bond market, and we didn't see politics disrupt the global environment. No surprises.
So in terms of investment performance for 7IM during 2017, we hit the expected returns, a little bit better in the upper risk profiles and a shade under in the lower risk profiles, but on the whole hit the expected returns while having protected against tail risk that, as it turned out, last year didn't materialize. We're okay with that because our job is not only to hit those expected returns, it's to protect your customers' capital. Okay, Ben, let's take a look at what we think we're looking at for 2018. Is this glass of water half empty or is it half full? Give me the half full case.
So the half full case is that the synchronized recovery we've seen continues. It's what a lot of people are expecting. That will lead through into corporate earnings, growing at rates that we've seen in 2017. And it may even lead to capital expenditures coming back, which is the missing piece, which is companies going out there, investing in new factories, new machines, and maybe hiring some new people along the way.
And to add to that, we've got our friends in the States contemplating a very, very substantial tax cut. What would that do to the market?
I think the tax cut would be positive. Most of the companies it helps out are the ones that are looking to make those capital expenditures. So it gives them an extra boost. That's no bad thing.
So if I'm listening to this conversation, I'm saying that that glass is not half full, it's completely full. Why is it that we're not going to just pile into the market if we're looking at more buoyant economic activity, increased earnings, tax cuts? What is it that we're concerned about?
One thing we're concerned about is something we haven't been concerned about for a long, long time, and that is inflation. Because with inflation comes the risk that central banks start to raise rates more quickly than expected. And we're seeing inflation come. The chart on screen shows wage growth in the United States, and it's back to the kind of levels we saw in the mid-2000s. You think back to that time, interest rates were not where they are now. If they start rising quickly, that could be a problem.
Now, the stock of debt is a great deal larger than it was maybe 10 years ago, and on the back of all the low rates that we've had. Does that matter?
There are some companies, zombie companies you might call them, who've only been kept alive by the fact that they pay such low rates on their debt. If rates increase, and if they increase really quickly, then they may struggle, and you might start to see defaults. Defaults scare people.
Okay, so we're looking at the possibility of inflation, on the back of that, higher rates, on the back of that, possible defaults. The other thing which comes into the equation is we're starting to see central banks reel in the quantitative easing that they've been doling out into the market in heavy doses for the last 10 years. If that's the case, I don't know about you, but if quantitative easing was the tide that lifted all the boats, taking it away, you would think it just might do the opposite.
That's a great analogy. I think the issue is that we don't know how quickly the tide's going to recede and who will be left there when it does. So for now, we're concerned, we're watching the situation, but so are the central banks. If things start to move, we may change our view.
So really what we're looking at is, are we going to see central banks make policy errors, or are they going to manage what it is that they're looking at perfectly well? And we've seen both in the course of history. Let's talk about China for a moment.
China. So China kept the world afloat in the financial crisis. It did it again in 2016. When everyone else is scared, China just throws money at the problem. This year, they're suggesting they might not do so. They might take the chance to fix their roof while the global economy is going well.
So they're worried about the amount of debt that they have in their economy. They're worried about the property market prices, and they have announced to the world that they are in fact going to manage that down. So once again, that in and of itself, not necessarily a cause for worry, it's can they manage it without a policy error? So what we are worried about, in essence, if I could paraphrase it, is policy errors either by central banks or the Chinese would be the kind of things that could upset that wonderful environment that you painted on the half-full case.
Exactly right. Those are the risks we see out there.
Okay. Ben, we said we'd have a quick word on Brexit. What's your quick word?
The quick word is that we're less worried about extreme outcomes. We're not so worried about a very, very, very hard Brexit, and we're not so worried about a shock return to the European Union. What that's done is narrowed the range that the currency can trade in, and that's the most important thing for portfolios.
So the big concern for us with Brexit was the currency, and we're not looking at the extreme range of possibilities that we were a year ago. Fine. Let's talk about now what it is that we're going to do in the portfolios going into 2018. Shall we start with equities?
Absolutely. In equities, we are slightly underweight. There are areas of the equity market that look a bit expensive, and there are areas that look attractive. We'll be favouring the ones that look attractive.
Which are which?
Well, so for the first time in a long while, we like the UK mid-cap sector, which is a bit more domestic. The tone of direction in Brexit is a little bit more positive for the UK economy. The consumer is still confident, and for the first time in a long while, those smaller UK companies are trading at less of a premium than their larger counterparts.
That's quite unusual, isn't it?
It's very unusual. We've rarely seen it since the crisis, and that gives us an opportunity to invest.
Okay, so where are we adding, where are we subtracting in terms of global allocations?
Well, so we also like Europe. We've liked Europe for some time, and we continue to think that the profit growth there has not yet been priced into the market. So we're overweight Europe, slightly underweight the US, where we've seen such a spectacular run, particularly in the tech stocks. So in the US, we're a little underweight, and we favour some of the smaller companies that should do well out of the tax cuts we talked about.
So if we look at those risks that we talked about before, if they materialize, they might be liable to poke their head up in the equity markets. Is there anything, while maintaining our exposure to equities, is there anything that we can and are doing about that?
Where we can in portfolios, we're looking to take advantage of cheap volatility. It's about the only asset that's cheap nowadays, and it lets you buy portfolio protection. So what we're looking to do where we can is buy portfolio protection that in the event of an equity market correction, a sharp move downwards, will protect our clients' capital.
Okay, so a little insurance in the portfolios for equities. Fixed income. We haven't liked fixed income during the whole of 2017. We still don't like fixed income, but there's a few more nuances now on those thoughts. Let me draw you out on exactly what they are.
So we talked about companies not being able to pay their debts quite so easily in a rising rate environment. Because of that, we've cut back on our high yield bond allocation a little bit. We're just worried that there might be a few people out there who find they're in a more sticky situation than they were a couple of years ago. The main thing though in fixed income is that we are underweight duration. We are underweight interest rate risk. We are worried about interest rates around the world going up and that destroying the capital value, particularly of our more cautious clients.
And the way that we've been dealing with that during the course of 2017 and again now in 2018 is we've replaced gilts in the portfolio with a basket of alternative investments. And those alternative investments in 2017 actually did pretty much what we asked them to do. We wanted them to produce gilt-like yields with pretty low volatility, and they came up with about the basket about 3.5–4% return last year with the low volatility. Had we left the money in gilts, we would have had what?
About 1%. So you'd have got your coupon and nothing else. We're very happy with the way alternatives have performed this year, and we expect to see it in the future.
Okay, so maintain the equities, a little bit of insurance on the equities. On the fixed income side, getting rid of some of the high yield securities that we have. On the currency side, what are we doing there?
On the currency side, we're a little bit overweight sterling. We think at $1.35 it's still a bit undervalued given that the UK economy is still growing. But we're less concerned, we mentioned it before, we're less concerned about the sharp moves that we were seeing over the past couple of years. The Brexit situation seems to be moving towards a range for sterling that's a lot narrower than we've seen recently.
And cash?
Cash is at about 10% in a balanced portfolio, which is about double the strategic neutral. We're quite happy to sit on cash. We're quite happy to wait for an opportunity to invest it. We don't feel the need to chase returns.
There's a summary of what 7am is going to be doing in the portfolios in 2018 to hit those projected returns once again while protecting your customers' capital as we did in 2017. And we hope to do in 2018, 19, 20, 21, and on and on and on. So with that in mind, here's to 2018. We'll see you next quarter.